Hello everyone, hello ma'am. Myself Radhika Mantravadi with ID 1942342. I have done research on the topic impact of the capital structure on the profitability of organizations. Capital structure is one of the major decisions which the top management has to take, and it's very much concern for the financial managers as it will impact the profits of the organization. This assignment has basically focused on analyzing the profit behavior of the capital structure in different forms at different life cycles of the organization. The project is focused on analyzing the debt and equity ratio portion in the capital structure. This will help us to understand the relation between the life cycle of the organization, their capital structure composition, and the profit element available. When I get into the further literature review and research, I got to know about the other questions. I got to face few more questions like generally the obvious fact which everyone is known for all the organization, irrespective of the scale, need money to fuel their operations of the organization. For that, they have to raise funds. And what sources does the business use to raise the capital is the first question. It is debt and equity. Debt refers to the loans which are borrowed from the banks, financial institutions, and the organization has to pay back the debt with interest agreed. And the other one is equity, which is common shares, preference shares, and the other one is reserves, which is the return earnings of the organization, which all put together, it's an equity. There is no need to pay any interest on the equity, but they have to pay dividend to the shareholders as they are the owners of the, but they are the partly owners on the equity. When it comes to debt, the investors are the debtors. So interest is the mandatory which the organization has to pay, irrespective of the organization situation. And the next question is, what is the cost associated with the capital generator? Every capital has a cost attached to it. Quite similar, the banks which provide loans for an interest. So cost of equity is always the more than the cost of debt, as the risk associated with equity is more compared to that of debt. High proportion of debt in the capital structure of an organization means the organization is more financially leveraged, as the business organization which is able to generate the capital with low cost is said to be more financially leveraged. But from investors' point of view, in their perspective, capital structure with low debt is preferred, as the risk is more with more debt. So to understand on this more, there are few theories which are recognized, that is theory of net income approach. Since the cost of debt is comparatively low with equity, the weighted average cost of capital would also significantly reduce. Hence, can again more income, but this suitable for small businesses, not for the big firms, as the manufacturing and construction sectors have high debts, but IT sector has low debt. This means there is no particular value which sets the benchmark for all industry participants, but there are some industry specific values which can help. There are few debt ratios which can help to evaluate. There is another theory which is called as operating income approach. In this theory, it is a complete extremist point of view, where the capital structure, irrespective of the proportion of the debt and equity, the weighted average cost of the capital remains the same. Hence, the value of the firm remains the same, and the risk also remains the same. So basically, it states, irrespective of the capital composition, there is no difference in the cost of capital. And to understand more on the capital structure, the strength of the capital structure, there are few ratios which will help. There are many ratios, but there are mainly three important ratios which are connected to the capital structure. That is debt ratio, as the name suggests, is the ratio between total debt to total assets. And the another one is debt to equity ratio, total debt to total shareholders. And the third one is capitalization ratio, which is long-term debt to long-term debt and shareholders' equity. With these financial ratios, the key question is again, what is the optimal proportion of debt and equity to the capital structure for an organization has to be. And then when you come to the another concept, this is financial leverage, which will help to certain level. This is when a firm has high debt, has high financial leverage, which is already told that there is a high debt, then it is said to be more financially leveraged. But however, there are certain pros and cons for this. There will be a lack of freedom of operations because a high degree of debt means the bargaining power of the suppliers and the creditors is high. So the organization has no freedom and it has to work on biased. Hence, the performance may impact, which can get out of the track of their vision or mission. And another one is low profitability. The increase in debt means paying interest. It eats up the baseline of the organization. And the another one is highly vulnerable to economic crisis. Unlike equity, where an organization pays when it earns profits, it shares its profits to the shareholders. But irrespective of the performance of the organization, it is mandated to pay the interest to the debtors because this is a debt for the organization. So there are these challenges which the organization has to face when there is more debt. So flexibility will be less. So therefore, while analyzing the composition of capital structure, there is another financial ratio which is called as interest coverage ratio. This is the ratio which measures the ease which a business can be able to pay its interest on the debts. This is the ratio which is calculated dividing the overall earnings of the company with the interest expenses on debt. In addition to the interest coverage ratio, there is another means to evaluate the organization, that is credit ratings, which is given by the famous organizations, reputed organizations such as S&P, D&B, and so on. These credit ratings perform thorough risk of the organization. They evaluate the company and state the riskiness of debt of a particular company. This will help the organization to take the debt, the amount of debt which it can afford, and it will help the investors also to invest on the organization. After studying all this, I have selected a method to evaluate. This is working on different life cycle of an organization. So there are three levels of organization, basically, that is growth, expansion, and revival stage. At growth stage is the stage where the product is already accepted in the market. They have new ideas to expand or just started to expand. The organizations at this stage has stable cash inflows. And the another one is expansion stage. These are the entities which are looking for diversification of their product in terms of the product, completely new product, or it is planning to enter into a new market in a new location. So basically it faces the competition and it has to reduce the cost to attract the customers. And the another one is revival stage. This is the stage where it has passed through the growth and expansion. It is looking for the opportunity, like it is looking forward to start a new life cycle, which it can begin with the new product. So basically they want to invest on research and development. These are the firms with large amount of equities and reserves. And I have considered to undergo this method of analysis, I have considered the data of total 30 organizations, 10 each phase, which are recognized in UK listed companies, and the data is available publicly. And the ratios are the ones which I have obtained. The data is analyzed in terms of 4, comparing to the equity. When we raise an equity, how it is going to affect operating profits, net profits, return on equity, and return on assets. So, when we consider the figure 1, which shows equity proportion and operating profits, the basic chart which shows the relation is the relation in between that when equity is raised, how the operating profits is going to get impact. When we see the company 1 and 2, it is exceeded. When we see the company 3, it is decreasing. Same way after the same 4th and 5th company is increasing, and finally 7th and 8th company is increasing, but the 6th company is decreasing. So there is no correlation. It's not a standard way. It's no relation between the operating profits because, and it is also affecting the same way on return on assets in the business. Here we need to think about the theory of operating income, which was previously explained. It is irrespective of the structure, the firm's value will be the same. And also the cost of capital is also the same. Hence, the raise in equity does not impact on return on assets. Similarly, operating profits does not consider the payment of interest. But the companies at growth and expansion stage requires high amounts of funds, and if these requirements is fulfilled by the debt, the firm has to pay higher amount of interest, which will impact the profits. When we look into the figure 2, it is showing the relation between equity portion and net profits. This chart shows a positive trend. Increase in equity is increasing the profits as well. This is a positive trend for both growth and expansion stage. When we look into the figure 3, at revival stage, the red bars in the chart above, it is increasing, but the blue bars are also increasing. But this is in the case of figure 2. But when getting to figure 3, equity is increasing at higher value, but the net profits is not increasing at the same proportion. It is showing a relation, but in an inverse. It is a negative effect. So, after getting to analyze this data, I concluded that from various analyses, it looks like the profit elements have been different. When we look into the operating profit, it is not showing any impact because it does not consider interest. And net profits raise with the raise in equity. But it is not in the case of revival stage. At revival stage, it is not increasing because though they have high equity, the profits are not getting recorded because due to the low confidence of the shareholders, they involve in the management decisions, which will affect the performance of the organization. And the another one is the traditional approach, which states that the optimal point can be arrived with increase in debt. But to certain cost at a certain point, if it does not, it will impact on the cost of equity. When the debt increases beyond a specific threshold, it has an impact on the cost of equity because no one would like to invest in an organization which is more in debt and high debts because it is risky for the investors. And hence the financial leverage of the firm also states that interest rates on debt are invariably less than debt. Still, it must be noted that investors would like to invest in the organization which has a proportionally balanced organization. Again, it depends upon the nature of the industry, scale of the industry and operations. I have given 2 recommendations of the capital structure. When we look into the left side bottom, it's the capital structure of Unilever. It's an FMCG sector. The company is primarily fueled with debt. Debt constitutes of 67.8% of overall capital structure, and out of which the long-term debt is 57%. The key recommendation here would be that the company needs to further deleverage the balance sheet to have a flexibility. And the capital structure, the another capital structure, which is at the right side bottom, it is of Royal Dutch Shell. This is oil and natural gas. In this organization, the capital structure is balanced. The total debt is 34% and overall in the overall capital structure, while the long-term debt is 28.8%. This means the company has majorly invested in long-term debt, acquired the capital from long-term debt, and have few short-term debts. The key recommendation here would be company has to use more long-term than the short-term, because the long-term debt cost of is interest will be less when it is compared to short-term debt. This is the research which I have undergone, which helped me to understand the capital structure a bit more, and it has given me the results which I was desired to get. Thank you.